To build anything that truly lasts, it takes time.
Welcome, Deven Choksey on the show right now. Hi, Deven. Morning. Good to be speaking with you. And Deven, though the markets have shown a very good move just on Monday itself, but a lot of earnings that are in focus. And let me start by asking your take on the cement pack, because it was Ultratech that did come out with a decent set, but the management commentary is really good, where they have guided for a double-digit volume growth in FY26, and a lot of these brokerages have actually gone ahead and raised the target price. What's your take on the earnings for Ultratech Cement? How do you look at the management commentary, and do you believe that this can actually bode well for some of the other cement counters as well today?
Yeah, good morning. I think spot on. The cement companies definitely looks, I think, they're interesting from the point of view of two counts. One, the volume rate growth, capacity utilizations included, is expected to be higher in the current financial year. Couple of reasons. Of course, I think the construction activity which continues, so that gives the strength. More importantly, I think the fuel cost, which is basically remaining lower, which is an energy segment, I think, within the commodity space. I believe that I think it's expected to even produce better results, largely because of the fact that on one side you have got a volume growth, on the other side the profitability growth. I think both of them put together, giving the advantage to many of the cement companies to register better profit performance in the current financial year. Ultratech being the largest, ECC Ambuja would be next one to follow. I guess I think the larger cement companies with a better market reach are in a better position to create the impact as far as I think the profit performance is concerned. So we remain distinctly positive about the possibilities. In selective pockets where the companies have expanded the capacities and have been in a position to register better growth, I think they too could possibly have relatively better performance than what they did in the previous year. So certainly this year could be, I think, a year of cement companies as far as I think the growth in the profit is concerned.
Deven, how much of the damage from the earnings from RIL is now in the price already adjusted in the fall in the stock yesterday? Because it was a tough quarter, but that growth confidence that one was hoping for, that has sort of, refused to play out. The guidance, of course, continues to be optimistic with that plan to double the earnings in 2029, despite the misses on both retail as well as, the fuel refining segments.
Yeah, I think more than the disappointment on the quarterly results, I think the concern is also due to the fact that Russian crude oil sanctions and the resultant impact coming on to the exports of refinery products. I think that's where the concern has been largely overhanging in the mind of the investors, and that's what probably I gather is a root cause of the fall in the stock price yesterday, despite of good results. Per se, I think the results are not bad. On the contrary, I feel that consumer-facing businesses, the platform, Geo platform, as well as the retail business, both of them have shown remarkably high amount of performance. In fact, I think Geo platform promises to grow at 20% plus rate of CAGR growth on EBITDA front as well. And as a result of which, it is giving a vision of around 1 lakh crore EBITDA making company in next 2.5 to 3 years time from now. So certainly, I think these businesses are looking relatively more stronger than they were ever before. This crude overhang issue is basically the cause of concern at this point of time. Sooner we get some handle on it, I think the stock should re-rate. But fundamentals, according to me, remains quite positive and distinct for Reliance at this point of time.
Okay, so that's the take on Reliance. Also want to get your sense on the entire wires and cable space, because while Polycab's numbers were strong, Havells doesn't seem to be following that trajectory. Do you believe this is only on the back of weak summer demand? You have copper prices at play, or do you believe that there are certain fundamentals that are marring the sector right now?
No, the headwinds are definitely there as far as the copper prices, the profitability issue, and also at the same time, the white goods segment, I think, which you alluded to, is giving definitely I think, a good challenge to most of the players because everybody seems to have expanded into this space. And at the same time, I think the business growth is not as high as I think one would have thought about. So incumbents are also there in the game, and as a result of which, you are not getting the margin which otherwise you would like to get. So in my viewpoint, I think the cable business doing quite well. Of course, Polycab I think is a different kind of a business that model itself is a relatively more rich model as far as I think the profitability and the segment focus is concerned. But we believe that I think the white goods segment would continue to have the same level of headwinds or challenges. Even though there is a growth available, the margins would be always under pressure.
All right, so that's the take coming in on Havells, and let's watch out for some of the other companies as well today. But the other stock that is going to be in focus.
Environment, frankly, any newcomer taking up the position, having a strong legacy, is always going to find it challenging to physically score in the environment in which we all are operating today. So, not completely surprised. I think in the corporate world, I think this kind of jerks do come up from time to time. I think the top level management is quite capable of handling this particular situation. And in my viewpoint, I think this company has always demonstrated that their ability to, I think, build a good team, they always demonstrated. So we'll wait and see, I think, who the next person they will name as for running the MD position. But in my viewpoint, Rajiv Jain taking over the charge until March 28, I believe that I think they are very clear with their objective that they want to install a very stable and a seasoned person in the job.
Deven, how much do you think ICICI Bank, given its NIM's resilience, non-core income actually lifting the earnings, and then HDFC Bank, which also posted a very healthy quarter, the focus, of course, is now shifted to loan growth. How much more do you think these stocks can fire because they're practically, in any case, at an all-time peak?
Well, on one side, credit growth is reasonably good in my viewpoint. I think the consumer finance, consumer credit definitely I think is promising to be better in the current year, largely because of the fact that you have a fair amount of disposable income in the hands due to the tax exemption limits increased. And because of that, I think the spending also increases. And along with that spending, the finance also requirement also goes up. So this is a cycle. At the same time, I think the cost of funds coming down is definitely taking a good sign. So all in all put together, I would think that this company with a larger EM base could possibly grow at around 15% kind of an average growth, at least in the next 2 to 3 years from now. Bajaj Finance kind of company is distinctly different, I think, which is promising to grow about 20% rate of growth. So in my viewpoint, I guess I think the consumer is a king at this point of time, and this is where probably these companies could register better performance. Fortunately, valuation wise, they are not so expensive. These companies are trading, I think, reasonably at a considerate valuation, as I call it as. So I think there is an opportunity in the falling market to buy this stock into the portfolio.
All right, so financials will be the key to watch out for. But along with that, Aditya Agrawal, help us with your take on Bajaj Finance. How is the chart setup looking like? Because just